everyone, welcome back to today's Explainer. We've got a really interesting setup today. The headline reads, KOSPI rebounds 0.73%, brokerage reports behind SK Hynix, Samsung Electronics buying. Sounds like a straightforward, positive day, right? Well, let's dive into the data, because that top-line number is actually hiding a massive and honestly fascinating market paradox. We're looking at a session where the overall market went up, but if you look closely, the vast majority of individual stocks actually bled out. So we really need to look way past the surface today and conduct sort of an elite market autopsy. Who actually drove this price action? And more importantly, what are the hidden signals telling us? The answers are completely data-driven, and trust me, they are moving incredibly fast. Okay, so on paper, the KOSPI closed up 0.73%, finishing the session at 6,856.83. Just looking at that, it's a totally solid green day. It indicates a really clear, healthy recovery from yesterday's brutal sell-off. But wait, check out the statistical anomaly hiding directly underneath that gain. We had 219 advancing stocks versus 662 declining stocks. So decliners literally outnumbered advancers 3-to-1, despite the index actually climbing. Kind of wild, right? The underlying reality of this is super clear when you look at the heat map. It is just a sea of red across the broader market, completely offset by two massive blocks of green. Capital flowed almost exclusively into two semiconductor giants. They were acting as the sole pillars holding up the entire index today. And you know what's crazy? This hyper-concentrated strength happened despite some seriously severe macro headwinds overnight. For one, President Trump proposed a 20% cargo toll in the Strait of Hormuz, which signals a renewed naval blockade. Concurrently, we had Federal Reserve Governor Christopher Waller issuing a pretty hawkish warning on core inflation. Naturally, U.S. markets fell across the board on that news.
But here in Seoul, we experienced this micro boom that completely decoupled from all that macro doom. Mariah Asset and SK Securities published these really critical reports today, pushing back hard on yesterday's AI memory downgrades. Their stance is crystal clear. Memory supply shortages are likely going to continue straight through 2027, and AI demand remains absolutely bulletproof.
The absolutely crucial piece here is the hard, fundamental data that's actually backing up those reports. Today, the Ministry of Trade revealed that first-half semiconductor exports hit a staggering $192.43 billion. That is the highest first-half total on record, period. It establishes an absolute, undeniable, fundamental floor for these tech giants. To put that into perspective, that figure represents a massive 162.5% year-over-year surge. I mean, this isn't just a slight beat we're talking about. This is explosive, undeniable growth directly tied to global AI server investments. And it's aggressively raising both shipment volumes and memory prices. So what did this all mean for the smart money? Well, foreign investors net bought 969.9 billion Korean won in KOSP shares today. But here is the kicker. Look at the concentration. 130.3% of that buying was targeted purely at SK Hynix. They were aggressively selling off other assets just to accumulate more Hynix shares. And domestic institutions, they were even more aggressive. They executed a massive 3.22 trillion won in net buying. They absorbed 1.38 trillion in Samsung Electronics and 1.29 trillion in SK Hynix. This institutional flow was just laser-focused on those two names. Now, let's pivot over to the derivatives market for a second, because this is where the momentum really built up. We saw a massive market basis gap trigger today. The actual market basis hit plus 11.51 points, which vastly exceeds the theoretical basis of 4.11. That precise 7.4-point difference creates an incredibly profitable mechanical arbitrage window. Basically, that gap flipped the switch on a 1.07 trillion won program buying machine. Arbitraging algorithms automatically sold futures and bought the underlying cash stocks. And because program buying executes as these massive basket trades, this flow artificially lifted the entire KOSPI 200 basket. It essentially dumped mechanical fuel right onto the fundamental fire. All right, let's switch gears and look at the hidden signals in the domestic battleground. While institutions were buying the dip with billions of dollars, what were everyday retail investors doing? Well, the financial hub of Yoido hides a much darker story for individual traders today. Individual investors dumped an incredible 4.14 trillion won in KOSPI shares. And get this, 87% of that selling was highly concentrated in SK Hynix and Samsung Electronics. Retail basically capitulated. They sold out at the exact moment foreign and institutional money was heavily loading up. But here's the really rough part. A significant portion of this massive retail dumping wasn't even voluntary. We saw a wave of classic forced margin liquidation. Yesterday's brutal double-digit drop in SK Hynix pushed a ton of heavily leveraged accounts past their breaking point. So brokers stepped in today to close out those clients, which triggered this vicious, automated cascade of retail stop-loss orders. So you might be asking yourself, was this massive tech rally just short sellers covering their tracks? The data says absolutely not. If you check out the large cap short selling ratios, SK Hynix saw a tiny ratio of just 0.90%, and Samsung was virtually non-existent at 0.47%. Today's massive rally was driven by stable, organic new buying, not some temporary short covering illusion. However, if you contrast those ultra-stable mega caps with the KOSDAQ semiconductor equipment makers, it's a totally different picture. Companies like PSK and Wanik IPS hit massive short-selling ratios of 14.45 and 12.03% of their trading value. Down here in the small caps, we had a completely different mechanical force at play. In these smaller caps, short sellers essentially got caught in a classic squeeze. Mounting losses forced them to buy back shares immediately just to close their positions, which artificially drove up prices. But remember the danger with this. This specific type of buying pressure vanishes instantly the very moment the covering demand is exhausted. So we've just seen how rapid microdata updates and algorithmic flows can completely override macroeconomic fears, essentially tearing the market into two entirely distinct realities. As algorithmic machines tighten their grip on liquidity, who do you think is going to win tomorrow's opening bell? Welcome to the new market reality. If you want this daily explainer on the closing of Asian stock markets delivered to you before New York even opens, make sure you hit subscribe. We'll see you next time.